Income tax 2020. Exception for rental real estate with active participation. Come in, relax with income tax 2020. Exception for rental real estate with active participation. When thinking about our income tax equation, we're going to be up top in the income line, realizing that we do have a separate schedule, that typically being the Schedule E, which is in essence another income statement having income and then expenses, which are basically deductions. Bottom line of that income statement, in essence, net income, then rolling into the top line of our income tax equation, where we then apply out our above the line and below the line deductions to get down to that taxable income. With regards to the 1040, we're going to be looking at the first page, focusing in on line 8. When we do our example problems in software and with the forms, we'll get more into the actual forms, but just realize we're looking at something that will typically flow into line 8 on the 1040, and then the Schedule E. This is the first half of the Schedule E, just for an example. Second half, down below, we have the 20,000, basically the net income here that is carrying forward. Remember that although the forms are out for 2020 for the Schedule E, we don't have some of the other resources out yet for the publication 527 and the instructions for Schedule E. Therefore, we're going to take some of this information, much of this information coming from 2019 publication and instructions, and then making adjustments where applicable, but realize the baseline of it's coming from the 2019. And you can look at this information on the IRS website at irs.gov, irs.gov. Look up publication 527 and instructions for the Schedule E. Those 2020 updates should be out shortly. Exception for the rental real estate with active participation. So we got this exception. We have the passive activity rules in play here. Those could limit the losses that we might be able to take. And then we have this exception that we want to talk more about with regards to the active participation. So if you or spouse actively participate in a passive rental real estate activity, you may be able to deduct up to $25,000 of loss from the activity from the non-passive income. So this is how I would kind of think of that, about this, basically as a back and forth with the IRS, right? The IRS is basically saying, hey, I'm skeptical of the losses you're taking that might be taken from rental property, and therefore we're going to apply the passive activity rules to all rental properties, kind of what they started off doing. And that means that you can't take any of the losses. You wouldn't be able to take any losses according to the passive activity rules and against other types of income, such as W-2 type of income, but rather would have to roll it forward and only be able to take the deduction if and when there was active income to net it against. And then the real estate people said, hey, well, that's not really fair because, maybe we do some active participation in it. It's not totally passive. I'm working for my rental property. And so then the IRS gives a little bit and they say, well, if you're an active, if you're a real estate professional, then possibly you get the losses. And then even if you actively participate, which is kind of the in-between zone, we're going to allow you the $25,000 of the loss possibly to take, as opposed to matching it out. So $25,000 then might be something that you can then take against other income, like active income, like W-2 type of income. So this special allowance is an exception to the general rule disallowing losses in excess of income from passive activities. So the default rule, you can't have losses because we're going to say it's passive unless you have passive income to net it against. But now we have this exception if you actively participate, and that's the $25,000 of losses you can take against other types of income that would roll into the first page of the 1040 and possibly net against income such as W-2 income. So similarly, you may be able to offset credits from the activity against the tax on up to $25,000 of non-passive income after taking into account any losses allowed under this exception. So here's an example. Jane is single and has $40,000 in wages, $2,000 of passive income from a limited partnership, and $3,500 passive loss from the rental real estate activity in which she actively participated. $2,000 of Jane's $3,500 loss offsets her passive income. So the first thing, so she's got $40,000 normal income, $2,000 passive income. So we've got this passive income. And that's the thing you normally would net against if you didn't have this kind of exception of the actively participating. So you got the $2,000 of passive income from limited partnership and a $3,500 loss. So that means that you should be able to net these two together, right? The 3,500, you could get 2,000 of that loss. You're left with another 1,500 after you net out from the passive wages. So 2,000 of Jane's 3,500 offsets her passive income. The remaining 1,500 loss can be deducted from her 40,000 wages. So that's where the question would be right here. If we were strictly having the passive rules and you were not able to take the active participation exception, then you wouldn't be able to take this 1,500 that are the passive losses over the passive income. But with the exception, then you can net out this 1,500 against the 40,000 from wages, W-2 income, which would be active income. So active participation, you actively participate in a, so now of course, well, if you have rental property, you want to be actively participating if you're going to have losses so that you could take, that 25,000 if possible of the losses against active income. So what does it take to be active? So you actively participate in a rental real estate activity if you and your spouse owned at least 10% of the rental property and you made management decisions or arranged for others to provide services such as repairs in a significant and bona fide sense. So obviously this is a little bit vague, right? In a significant and bona fide sense. So if you have rental property, now if you have rental property, you might hire, say, a management company to basically manage the property, in which case you would think it would be a little bit more difficult to qualify as active participation. May still be able to do it, but might be a little bit more difficult. If, of course, you're actively managing the property, you don't have like a management company, then you would think it'd be much more likely or easier to justify say that you're basically actively managing the activity. So management decisions that may count as active participation include approving new tenants, deciding on rental terms, approving expenditures, and other similar decisions. So that's what you want to keep in mind if you are obviously if they're thinking about having someone else help them out with their activities and they want to be actively participating, then you want to be logging down and noting in the event of an audit that you have active participation in accordance with some of these items. So example, Mike is single and had the following income and losses during the year. So salary $42,300, dividends $300, interest $1,400, and then the rental loss of $4,000. The rental loss was from the rental of a house Mike owned. Mike had advertised and rented the house to the current tenant himself. So he did the work himself. That looks like some active participation right there. He also collected the rents, which usually came by mail. All repairs were either made or contracted out by Mike. So it sounds like Mike is the one basically doing the management decisions in this case. So although the rental loss is from a passive activity, because Mike actively participated in the rental property management, he can use the entire $4,000 loss to offset his other income. So again, if you had like a rental, if you're hiring a management company to do some of that stuff, then you want to be, it's a little bit more questioning, of course, as to which decisions are being yours versus possibly not yours in terms of passive income and whether you actively participate. So we have the maximum special allowance. The maximum special allowance is $25,000 for single individuals and married individuals filing a joint return for the tax year, $12,500 for married individuals who file separate returns for the tax year and lived apart from their spouses at all times during the tax year. So generally you got the $25,000. So it's generally $25,000 if you're single and you're thinking, well, then if you get married, do you get to take deductions up to $50,000? No, you still get the $25,000, but you may get a benefit in order to qualify for active participation in that you'd possibly be able to count the participation from both spouses, but it's not going to double the amount of loss. But it would then go in half, not when you go to single, from married to single, but if you're filing in a married filing separate kind of situation. And then $25,000 for qualifying estate reduced by the special allowance for which the surviving spouse qualified. Now we're going to look at the modified adjusted gross income limitations. Note that I believe these are still coming from the 2019 information. I think they're the same, but if there's any differences, possibly we will put them in the notes. But just realize I believe this information is coming from the 2019 publication and instructions. But just note there's a modified adjusted gross income limitation, basically an income kind of threshold here. So if your modified adjusted gross income, MAGI, is 100,000 or less, 50,000 or less if married filing separately, you can deduct your loss up to the amount specified above. If your modified adjusted gross income is more than 100,000, more than 50,000 if married filing separately, your special allowance is limited to 50% of the difference between 150,000 or 75,000 if married filing separately and your modified adjusted gross income. So it's going to start to basically phase out. There's kind of a phase out process. Generally, if your modified adjusted gross income is 150,000 or more, 75,000 or more if you are married filing separately, there's no special allowance.